Good. Yeah, thanks.
All right, please make them feel very welcome on stage.
Check, check. There we go. Cool. Okay, what we're going to do is I'm just going to give a really quick intro into all of you, and then we're just going to dive into questions to make it super actionable. So Adrien on my left, or for your on the right, co-founder and board member at El Dorado, platform which connects startups with private investors and funds. 400 plus tech companies financed yearly, around in 3,000 in total. Co-founder is Les Pepites, community for French startups, around 13,000 companies in there. And he's an advisor for family offices and funds. Then we have Gary Fowler, family office, 70 startups, which 2 of them are unicorns, 160 in their portfolio, and then 59 countries, right? There we go. And then we have Samantha investing in early stage companies for digital transformation, 1 billion in management and mostly in Europe. And then we have Matthieu, he's like me, a founder, building 3 to 4 startups per year, has been around for 10 years, so 30 companies in total, all of them are funded, and 3 of them are worth more than $1 billion. Correct?
Correcto.
Perfect.
So it's how many company we have like above the billion, right? It's all about this, right?
Yeah. So I'm just going to start with a super basic question. You have VCs and family offices, right? So Gary, how is a family office different than a typical VC?
Well, first of all, how many of you know what a family office is? Raise your hand. So imagine 99% of the wealth is held by 1% of the population. These people become your greatest cheerleaders. Rothschilds, Rockefellers, DuPont. I was just with them 2 weeks ago in the Hamptons. They can cheerlead and help you. They are the limited partners in all the funds. Think about it. Why in the world, you heard selling, how many have had sales training, right? You sell to the top. Why wouldn't you go to the people that have the money? The difference is they have the money. So we deal with family offices. We are a family office, mine, a small family office. But the thing is, we're also a connector to the other family office, the large ones in Europe, the large ones in Asia, the large ones in the US. And trust and credibility are intensely important. If you have trust with those families, because they have doors to go to somebody like Bernie Arnault, right? You just don't go into Bernie. Louis Vuitton, you got to use Gary Gessler to get into the gate. You need to find those gates. What's the difference? They make decisions that are a little bit longer term. Think about it. The typical VC is between 24 and 33. Only 10% have ever built a company. These people that you're dealing with many times have built companies. Go where the building is.
Nice, I think that was pretty clear. Adrien, so you guys
No
connect
more
startups.
question, please.
What's that?
No more questions.
Just answers.
Yeah, nice. Adrien, you connect startups with investors, have access to a lot of data. Like, what do you currently see happening in the funding environment right now?
Yeah, actually, to speak about like family offices, even in France and Europe, it's getting more and more increase in the last decade. In France, we have like around like 40 active family offices as well. So I'm not going to rise up like you, but I'm a strong family office advocate as well. And so yeah, we talk about how to be more positive about the market in the last 2 years. With this market that has been evolving really fast. 80% of the SaaS funding has decreased in 2023. So to be more optimistic, first is to say that 2024 is more a recovery year. And even more than that is the best year we have known in the past 20 past years, excepting the 2 outliers years of 2021 and 2022. So this is the first great things to have in mind. Around like 20 billion euros invested in the first semester in Europe for tech companies. So it's much better than 2023, obviously. And the second trimester, the second quarter is even better than the first one, around like 8 billion investing throughout Europe. So the market is positive. The resilience in SaaS ecosystem as well is shown. More investors are now discussing about valuation, and not just only with a defensive point of view. So for entrepreneurs is to say like we are in a more optimistic market, but it's more a cautious optimistic market that we have to bear in mind as entrepreneur. The investor point of view and the investors' expectation has a little bit shifted from the past. They are not only looking for innovative founders with a strong innovation background and a strong technology inside their company, but also they are looking for entrepreneurs that can show how they can be more with a sustainable growth, with a path to profitability more studied and more understood at the beginning of their company, because they want the company to be more resilient in case of other crises and other uncertain environment, as we know. Because nowadays, like even if the interest rates are getting lower with the time, the market is still with lots of uncertainty, like the election in the US is coming up. There are several wars, so lots of things that can be a part of a market that is not completely optimistic. And so the statistic of that could show that 2025 will also be a year with more a recovery year as well. So with the time, it's going to be a more attractive market for the investors as well. And regarding the stats, like what we can say as well is that the software companies is the fourth sectors that is in order with after health, I think, and after energy and fintech in the European market, with 5 billion euro invested since the beginning of the year. And as everybody may know, like UK is still the first countries regarding the startup investment, around like 9.4 billion euros invested in the UK ecosystem, in cooperation like France and Germany, which are 2 and 3 with 4.5 billion euros invested. So the market is getting better. One last thing that's interesting to bear in mind, like 25% of the deals made this year are for flat to down rounds. So you need to bear this statistic in mind, because in a market that has been so much decreased, it's important to have this statistic. It's lower than in the 2008 crisis or in the internet bubble crisis, but it's still something to have in mind. Some of the money of the VCs are made to their own portfolio companies.
Cool. And to make it really practical, how many founders are in the room right now? And how many of you guys are looking for funding? Cool. This one is going to be for you, I guess, Samantha. Like, how do you now stand out as a SaaS company? Like, how do you actually get funded? So how do you make sure that you're going to be on the right side?
As investor, though. So maybe if I can, because it was a bit tackling like the VC industry, if I may, and I have to go back to what I've been said, and I'll answer your question. First, you're totally right. Like 2/3 of the money that coming from VCs, coming from family offices, multi-family offices, and we need those for sure. And there is the direct strategy that they have, like putting money directly in the company or putting indirectly money in the VC to spread the risk and to diversify a bit their portfolio. So you're totally right.
Also to anonymize, because they don't want you to know. For instance, Bill Gates doesn't directly invest in somebody that's a competitor, potentially Microsoft. So there's another factor that goes into it.
The non-conflict of interest.
Yeah, non-conflict. Plus, they just don't want to throw somebody's stock off because they see them invested in those companies.
And to go back to what have been said, like for the entrepreneur that are in the room and the ones that wants to open chakras for having VCs around the table. So it's what you have to know, and to go back to what I've been said, we're just getting back to the valuation of 18, which is not like serious. Like, come on, we're just coming from this climax that we went through in 21, 22. That was just like nonsense compared to the usual multiple that we had in mind back in 19 and 18. So we're just coming to the valuation, we're just coming back from the valuation of 18, which is not a very like serious problem. It's just a fact. We're coming back to normal valuation. So this is something that you don't take it personally. It's just the way it is. The cycle of the VC industry is just ups and downs, and we have to deal with this, and that's part of the game. The way we do investment now, and you're right, we're coming back to true things, meaning scalability, profitability. Profitability is not like, it's a word, it exists. We forget about this profitability path during 21-22, but it should exist for scalable company to making sure that you'll be there in 5 to 10 years from now. So we have to get back to something healthier, and that's it. So I don't think that this is negative at all. This is negative because on a daily basis, it's pretty harsh. It's pretty harsh to raise money. It's pretty harsh for GPs to raise money because there's tons of VCs that wants to raise money. Even if there's a lot of dry power in the market, there's a lot of healthy people that can buy and bet on VCs or entrepreneurs, still, we're just making choices and making bets a bit more professionally, I would say, than what happened during the climax of the bubble, because we're like sheep. Like in 21-22, we were doing like the other were doing, coming from the US, coming from Asia, and so on. And the valuation were raising and raising. Now we're just coming back to normal. So I think that we have to go back to, it's not a big deal. Just we're coming back on something normal. We continue to invest. We've been done, like we have done a couple investment this year. We're just very picky, as we've been doing the job in the past 20 years. We are very picky in the company, the entrepreneur, that will be resilient and that will go through those cycles. That's it. So I think we have to stop talking negatively about this market. It's just we're somewhere in the down round, but after the down round, there will be the up round. So just wait and be resilient. There is a lot of money on the market. 15 years ago, when I started in the VC industry, honestly, I made an interview to all the VC that happened in Paris, that have been there in Paris, so 20-ish. Now, there is thousands. And there is thousands all over Europe. So that's normal. There's plenty of money on the table. So I'm pretty sure if you're a good entrepreneur, if you have a good story to say with a breakthrough technology on a addressable market that's worth it, and you answer to a true need, you'll make the job and you'll raise money. It's not a problem. So I will put some positiveness here. We just been through this and we're gonna succeed.
Yeah, let me say, I've been in tech in Silicon Valley for 40 years. So I built 17 startups and 2 of them are unicorns. So I can tell you directly, this happens a lot. These cycles happen. And the one thing I believe, you think positively, right? The Pygmalion effect, the self-fulfilling prophecy. People don't want to hear you say, well, I don't know. Maybe this is going to happen, maybe not. You got to think positive. I'm not going to invest in somebody who says, I don't know if I'm going to be able to make it, right? I want to get shit done. The name of my company is Get Shit Done, GSD. Because it ain't about the talk, it's about the action. So each one of you out there, I've been in your chair. You understand? I did an IPO on NASDAQ. I've sat in that chair since I've been 21 years old. Now I do both sides of the chair. You each have the opportunity to change your life. This is a grand time with infobesity and AI and generative AI and quantum computers. We're working in those areas. 2 of them are here right now, one from Israel and my company from Lithuania, right here, right now. These are 2 of the top companies in the world. They come to us to grow them. We need the raw material that you have so we can put a sculpture in the Louvre. You each have the opportunity, but you got to take your mind and set in a positive direction, right? So just get it done. Just remember, GSD. It ain't about the talk. It's about the action.
Nice. And talking about action, Matthieu is also taking action. He's growing startups 3 to 4 per year. So also in the same chair as you guys. But all funded, right? So what do you focus on with your companies to secure investments?
Just to piggyback on what has been said already, but fully agree on 2 main things. First, on the funding side, I would say it's basically back to normal. And let's look at 2021, 2022 at abnormal years. So nothing crazy out there. But on the opportunity side, we haven't been this excited at eFounders, and we have been building companies for the past more than 10 years. We're super excited about what's happening in a sense that with AI and all this, many companies are now starting to equip themselves. You know, it's again a market where companies are equipping themselves. You don't need to replace another tool. You need to get on the new budget. A new budget is allocated on your solution. So this is great because it allows you to grow faster. So we're super excited about this. Okay. Now what we do, and it was much more difficult to do it well in 21, 22, is that because the market was a bit crazy, but we're back to basics, you know. So I'm a very old school guy. Okay. So all the startups we're building, they have customers. Yeah, we have customers before they raise funds. Like, we need customers to basically validate that we are onto something, that there is a PMF. And more than this, it's the early days, but that there is a une équation économique. Like, how would you say this in English? Well, a business model. Yeah, let's say a business model. And on the other side, as Samantha said, I think this is now that you find the great founders, or at least that you can show that you're one of them, you know, that you're one of the resilient person, okay? That you're one of the founders that will get better, like on a monthly, on a daily basis, and that look for this, and that will be challenged, that will face difficult times and all this. So for us, we're doubling down on what we're doing. So basically, helping our founders from good to great, and building old school companies that have customers. Yeah.
That's the key. Have customers, have an actual problem to solve, and have them pay for it. Adrien, back to you. What do you see? What do the companies do in your platform to get funded? Do they have like new approaches, strategies, any opportunities you can share with the audience?
Yeah, actually what is interesting is that the Silicon Valley framework that we have been using for the past 20 years is now evolving, I think, like with all the market insight that we had from the last 2 years, even the positive one with 21 and 22 with high numbers, high unicorn numbers and so on. The market is now stable, and the capacity of entrepreneurs to be different from this framework is interesting to dig about. Because entrepreneurs need to be like really cost efficiency focused. What we haven't been so highly recommend this thing to do in the past years. Being more cost efficiency is really being close to your business plan, and it's not a really big habit. Once again, that we have been developed with the great founders, that even from the past unicorns that we had. So in this market, like to be focused also on account management, really close from your customer, really close from your main KPIs is really important, because it will lead you to understand that even if the VCs, family offices, or funding opportunities exist and will exist, because you will remain optimistic and so on, it will take a little bit longer period of time to build this trust with your investors. They will look on your KPIs from your deck to the next 2, 4, 6 months, and to see if you achieve what you have been saying you will do 6 months ago. You need to be also more resilient about like the expectation of the amount of the fundraising you're looking for. Last year, I don't have one entrepreneur telling me that he achieved his fundraising with the first amount he had in mind before starting his fundraising. So having in mind that there's plenty other opportunities to fund your company and to be more resilient, even to finance your growth with revenue-based financing that has been a really big thing from the last 3 years, public funding opportunities, loans. So be more agile on the way you can finance your company. Be really close to your client's expectation, because it will lead a major difference to your competitors. Now the difference, and I saw lots of Gen AI companies, every Gen AI companies right now have 5 to 6 other startup Gen AI competitors, which is exactly or more or less in the same market with the same technology, and the differentiation would be who is the best handling his numbers and having the best a relationship with his customers, following your KPIs, the churn rate, being able to talk really deep about this will make the difference between two companies addressing a VC.
Cool, thank you. Gary, back to family offices. So we now know what they are, what they do. How do they look at startups? Like, how do they evaluate them? Because you mentioned they're focused more towards long term, right? So do they look at them differently?
Well, I have 3 of my startups, one from the US and one from Lithuania and one from Israel here. So we have an entirely different approach, right? You think about it, building a startup is like dating before you get married. We want to understand what happens with that startup. You know, my first graduate degree is in clinical psychology. You know, I studied business and psychology. Then I went to Russia. I lived in Russia, by the way, 12 years. I was a professor at the business school over there and went to Moscow State myself. But you each getting to know. It's like dating before you get married. The VCs are going to tell you, this is like being married. Well, I don't know about you, but the average VC meets for somebody about 2.7 hours in the US. I don't know. I would never marry somebody after 2.7 hours. We work with the companies for 15 weeks. We get to understand them from the inside out. Whether it's marketing or sales or customer development, are they fundamental? How do they operate? Can we help them? There are 3 things you need: operational expertise, access to capital, network and contacts, and a resilient team. And if you do that, any company can become a unicorn. I've done it. Click Software was sold for $1.35 billion, and I was on the original team, right? Eva, one of the first generative AI companies. That company was sold to Vaxelaire in Canada. I started in 2016. I raised almost $20 million. By the way, I had no sales. FYI. I had a billionaire partner that helped me, David Yang, and so having a brand name person with you does help. Right? It helps. And we're pretty well known in the Valley too. They know who we are. But you each have the same capability. Think about it. Find people that have names associated that can help you. Get the right kind of advisors. We look for those kind of things. You're right about it. It is about proficiency in efficient companies, customer development. Go out. You're the ones, you CEOs out there, are the ones that should get those customers. We look for all that, right? And we work with them for 15 weeks, so we get inside of the company, understand. We pick 7 companies from around the world. We're in 59 countries now. We don't care where you are. We only care about where you're going to go. So you each can do it if you really want to, right? And I say, you know, as a psychologist, right, manifesting, and we call it the big million effect. You become what you believe you are.
And you mentioned we don't care where you are, but where you're going to go. So make it real practical. If we look at valuations, do you look at where they are at that time if you're going to invest, or where they can go?
I look at where they can go. Well, I only care about you only care about what the upside opportunity of the companies. I have a company right now, right? This company's called Simple Night. It came to me with $0 sales. The company raised our first round is $23.8 million 15 months ago. Now we're raising $150 million. They didn't know where they were going to go then, but we understand where they are now. Now the company does, using generative AI and a multi-agent model, do incredible kind of things, right? Are they open-minded? Do they really care? Do they listen? Do they want to do it? Some people talk about it. It's like a game, right? They talk about building a startup, and they're just there for the club experience. I'm there to make a dent in the universe, to change the world a little bit.
Thank you. Samantha, back to you. So what kind of trends do you see happening right now with valuations?
Okay, so you want me to go back to the pessimist things. We're still seeing down rounds, and again, if you have raised money, a lot of money in 21, 22, obviously, if you didn't do well the job by increasing the top line or the EBITDA or having this path to our profitability, for sure there will be a down round, and I'm sorry for you guys, it's just the way it is. But as of now, the market is kind of divided between 2 worlds. There is the Gen AI things that is still like running tons of money with high valuation, nonsense compared to what they're doing in terms of top line, but true differentiator in terms of technology. So it's a pure bet on something huge that can happen in next future. And maybe to go back with what have been said in terms of differentiator in terms of timeline or time passed with the entrepreneur. When you're family offices or you're a VC, we're much more thinking as a family offices now, long term. So that's why the money has been shifted towards functionality, things that are going good, but just product, towards most long-term verticals such as health tech, climate tech, infrastructure, that kind of things. And this take longer by definition because it's very regulatory frameworks and so on. So it takes longer, and we have this in our models, and we know that we're going to keep longer our company in portfolio, but for good reason. So for now, the market is kind of divided between the company in Gen AI, run it like playing on a surface that it's completely nonsense in terms of valuation, but big bet and very high expectation on this, and the rest of the world. And the rest of the world just what should be done in terms of valuation. So again, nothing crazy here, just normal. And we are going back towards more long term, and we're now. 5 years ago, we were like the average was 6-7 years staying at company from the first check up to the exit strategy. Now it's more longer term, but we have it. We can stay 10, 12 years if we want to, but we have this in our modelization right now.
You know, there's one point for each one of you. The problem, we talk about generative AI, and the reason this has really taken off is because of infobesity. Each one of you had about 300,000 items in your personal cloud. The entire web in 1996 was 257,000 websites. You each have more information in your personal cloud than the entire web. The problem is your own personal clouds following the same trajectory, doubling every year. In 5 years, you're going to have 10 million items. Think about this. How many times each one of you in the last 2 weeks has somebody said, I sent you a message, did you get it? Where'd you send it? I sent your email. Which one? I forget. Let me check. I can't find it. Send it again. This infobesity is a problem. These tools, these incredible tools, Gen AI tools are there to be able to help us. Multi-agent, multimodal LLMs to help us solve those problems no matter what vertical market. We're inundated with data.
Matthieu, we heard a lot about AI already. I guess you're building companies yourself, right? Like, how do you look at it as a founder? And are you going to focus it more going forward? And yeah, that's the first question.
Yep. I would say first to segment a bit the market. So on the infrastructure play, on the application layer, for us, at least at eFounders, we look more at the application layer, at least for now. And to give examples, two things we are particularly excited about is industries that could not be tackled by software before. So it's really service as a software. And so, give you example, we look at industries that are historically 100% service-based businesses, and we look at how is AI going to change this. For now, it's not going to take over 100% of the service part, but at least it can take over some part. Just to give you a bit of example, and one that will ring a bell with Adrien. So we have a company, we are launching a company, sorry for the self-promotion, but called Reki, that basically help companies to raise non-dilutive fundings, okay? To go to the bank, to make a bank loan, to go to the BPI, get a BPI lend or subvention. And there is a lot of historically like manual work, service industry run by agencies, and we are making this a lot more easier. Like it takes less than 10 times less time to build something and to get approved. So we're super excited about this. Of course, another area is all on the legal tech side. Like the legal industry has been protected against software for like it's one of them that has not been disrupted by software yet. We think this is going to change in the next 10 years. So we're excited, and we're about to build a company over there. So this is one thing, service eaten by software, so super excited. And as I mentioned before, something else, we look in the AI space, and not to hype or anything, but we look at new pocket of investment, okay? We don't especially want to replace past tools, like we're not going to reinvent like MailChimp or whatsoever for a concrete example. We will look at, okay, new ways company is going to spend money, and so we don't need to replace incumbent, we just want to be in the new pockets of companies. So those are two trends we are very bullish on.
Nice. We have 10 minutes left. We're going to dive towards like 2025. So I'm going to ask the same question to all of you, starting with Adrien. Like, what are the trends you see for 2025? And I guess like also going to the title, like what do startups, scale-ups need to know going into 2025?
The crystal ball time. I will try to answer by discussing a little bit more about like Gen AI because it's a good example. Now, for Gen AI market and the sector is like the knowledge of both entrepreneurs and investors have increased like the last year and a half. So they are now looking for more AI and deep tech startups that have a really great product market fit, the best product market fit they can have. And once again, the ones that are really close to the most cost efficiency SaaS application they can have, because they are not in the market is recovering, as we said, but they are not in the same certainty that we have been seeing in the last decades. So prepare for the market recovery leads you as entrepreneurs like to, first of all, we talk about clients and so on, but also for the talent in your company. It's a challenging time for entrepreneurs to retain talent, to attract talent, especially sales talent. For a SaaS company, it's really key. So more than ever, being really close to your team, be really close to your clients, knowing what will be the fair price. You know, last week, Canva or Notion increased their price by adding like a new AI stuff or a new AI model. The prices are increasing, and the expectation of clients are increasing as well. So being really close to your sales team, customer feedbacks, and so on, it's a good preparation for what 2025 could be. There's a lot of emerging opportunities with AI, clean energy, life science, that will attract significant international family offices or investors. And what they want you to know as well is to not having a crystal ball, but also to be having a plan B or a plan C, because if the M&A market is not recovering fast enough, the VCs will take some more time as well. So you need to have to save more time for your startup as well. Regarding the knowing of your own valuation for the last round you have been doing, and what can be the expectation of an exit strategy for you or for your company. Imagine other ways to exit your company as well, like private-to-private M&As or IPOs if 2025 will open a target for this. So what I would say is like, don't be afraid like to read a lot, to talk a lot with investors about their expectation. Don't believe there's a statu quo about what we have been seeing for even the last year. It's evolving fast, so you need to be as agile as possible.
Thank you. Let's go right to Gary. Trends.
Yeah, so one of the things, I'll tell you a little story, and then I'll tell you how this relates to an incredible opportunity. 9 weeks ago, my basset hound got diagnosed with stage 4 cancer. I took a multi-agent large language model, and I had it go out and do research. It came back with a 100-page paper, and it told me what kind of therapies could work on my dog and who to exactly talk to. A guy at Yale University, Mark Mamula, somebody in Seattle, Washington, in a lab, Ardent Animal Health, down in Kentucky. It told me what procedure I needed to do. I went to the vet. I got a surgical vet, an oncological vet, and a GP vet. The surgical vet took the tumor out. I sent it down at a molecular level. We built a vaccine within 2 weeks that took my dog's down at a molecular level, her DNA, and actually created a vaccine to be able to ward off a cancer. My dog went into full remission of cancer, right? It stopped it, and then she went into remission. My thing is to the future is these think tank, these multi-agent large language models, because each of us need to have teams to be able to help us make decisions. It's not about one, it's about many. Now, if I can do it, I grew up on a farm in Pennsylvania, you can each do it. My dog's alive. You can look online. There's 455 articles. I'm going to be on Joe Rogan talking about it. My dog is alive because I used a large language model to be able to save her life. But that same model could be used for your grandmother, your parents. And I'm going to stem cell treatment because the LLM told me how to do it down in Thailand in 2 weeks. You want to get younger by 10 years? There's ways to do it. So use those tools. Companies need to use those tools. They need to have people like you bringing those tools to bear. So this is the greatest revolution we've ever had if we use it wisely. Use it wisely.
A lot of opportunities for startups to dive into this. Nice. Samantha, trends.
It's really harsh to go after you.
I'm sorry. I resemble that remark. I'm sorry.
Change the seats. Joke aside. So, no, maybe I'm going to talk about the way we reinvest in company that we seeded or that we make the first check on. So there is few criteria that we need to be green before we get another check into the company that we invested in. So the first one, because we are tech and deep tech investor, we're looking at the roadmap. You sold us a roadmap, a techie roadmap, really deep and so on. Did you achieve to make what we needed to achieve for the company for the sake of the product? First, so make the shit done in terms of technology, because at the end, this is the only set that works and that means a lot for potential acquirer at the end. Second is the team. Have you been able to gather senior international profile around you to make the shit done? If yes, then there's a green on our side. Third thing is equity attractiveness. Are you in the game of the VC industry? There's some people that are this in their gut, right? They present well, they know how to speak any languages, and they're really at ease on stage. But it helps. No, it helps because
Storytelling is 90% of building a billion-dollar
Exactly.
company. Just so you know, I had that course directly at Stanford University myself. It is it.
Gary.
We forget sometimes. Sorry.
So equity attractiveness. Make sure that you build the story behind, not just story, because we're gonna look inside the details to see if it's not a full story or a good story. But at the end, like the equity attractiveness, making sure that there's some VC on later stages that will be there to bet on the company that we've been seated. And the last one is kind of the financial trajectory. That's why we said in 21, 22, don't mess too much with the valuation, because you set the bar very high. So there is kind of an healthiness of your equity story that you have to have in mind. Don't chase for the bigger and the bigger and the bigger valuation. It doesn't make sense if you cannot reach the next step on bigger valuation and so on. So the equity attractiveness with the capital layer and the capital path is really important for us to get back and to play again and to bet again on a company that we invested in. So technology, team, equity attractiveness, and capital story that you build around your company.
Thank you. Last but not least,
Wow.
Matthieu.
Difficult. No, on our side, so we're very focused on seed stage. As we said, on the funding side, we're back to normal times. So for sure, traction is key for us. But let's not forget as well that how you build trust with a VC is a key part now more than ever. And by this, I mean, obviously, the direct connection you have with VCs, but let's never forget the indirect connection we have with VCs. We have plenty of stories here at eFounders and Hexa where basically a VC you're engaged with to raise funds will actually know from a friend or whatever, one of the customer that churned from your platform or that is happy about your platform, or someone that you wanted to recruit, managed to recruit, did not manage to recruit. And by this, I mean every connection or every interaction you have with someone on your market is an opportunity basically to look good and to build trust in this market and potentially with the VCs. So this is super important and something we stress for all of our companies.
Thank you. We have a minute left. Anybody has any questions? Yes. Hands go.
Awesome.
Let me just give you the mic.
How is AI impacting your work on a day-to-day basis, and not just simple things, but on top of saving your dog, what is the biggest impact in your day-to-day job as investors, whether family office or VCs or?
Maybe quick thing. It's helping us a lot in chasing, in new acquisition of building the pipeline and so on, because we're a seller, right? Either on the LP base or clients, the ones that putting money, or the entrepreneur base. So it's more a tool that we're using internally to grab either investors and new startups. But you won't, for now, it's not something that's replacing the human as of now. I'm not saying that in the future, in 10 years, 15 years from now, it won't replace something here. Obviously, we're using it on like comparables, competition, trying to find out a lot of information. So the analysis of a company is much easier now that we have those tools and so on. But it won't replace the trust that will be building between human, because at the end, it's the trust that you're building. It's a wedding. Like it's said, the only difference with the wedding is that you write it down the clause for the divorce, right? But this is the only thing that is different. So we won't replace. It won't replace the humanity and the fact that and the trust between people. But for sure, it's helping us from deal sourcing up to LP sourcing.
I think we're already late, but you guys will probably stick around to answer any other questions you have. So I think we have a session right after this. 4:30, the drinks start as well, so you can take the conversation there. Thanks, Adrien, Gary, Samantha, and Matthieu.
Thank you.